Let's face it, most of the time investors are caught up in the daily wiggles of the market. Um, but most of the time, these wiggles are just normal volatility, uh, brief profit-taking events. Very rarely does a uh, move back down indicate that a bull market has topped and that a bear market has begun. Over the last several years, we've seen lots of people try to call a bear market, and it just simply hasn't happened, and I haven't been expecting it to happen. As everyone knows, my expectation is that all of the years of QE, and Europe and Japan are still doing it, are probably going to result in another series of bubbles. So, these attempts over and over and over to try and call a market top have all been in vain. And most of the time, these moves down are nothing more than something like this. They're just a brief profit-taking event that then recovers and the market continues back up. So we've had lots and lots of these things along the way. So I'm going to show you one way to determine whether or not it's a good idea to ignore this kind of volatility, or whether it's maybe a good idea to start paying attention to it. So here's a long-term weekly chart of the S&P, and you can see we've had lots of these corrective moves here all along the way. Every single one of them, there were countless analysts predicting that a bear market was starting. When we got into this 7-year cycle low right here, I would say the majority of traders and analysts were expecting a new bear market. Probably 90% or more thought that this was the market rolling over and we had started a bear market. So let me show you, there's two ways that I determine whether or not we are in a bull market or bear market, or about to transition into one or the other. And a very good way to determine whether or not you should just ignore these volatile, corrective, profit-taking events. So what I've done is I've converted this weekly chart into the 100, 125, and 150-day exponential, 150-week exponential moving averages, and I've removed price. So you can see when these averages are moving up, that's a sign that we are in a bull market. Usually there is a period of flattening and then rolling over at tops. When we see that kind of action begin, then maybe we want to start paying attention to volatility rather than ignore it, because there is a possibility that a bear market could be starting. Same thing on the downside, only the inverse. As a bear market comes to an end, we'll usually see a period of flattening of these moving averages, and then the faster moving average will move back above the upper, and price will start to trend higher again. So using this long-term chart with these weekly moving averages, pretty clear to see, by late 2000, traders needed to start becoming cautious. The market it was giving off signs that maybe it was about to roll over and begin a bear market. In contrast here, by the middle of 2013, the moving averages have flattened and started to turn up, and it was time for good things to happen. And so now we move to our current chart, part of the chart here, and as we've known, people are constantly trying to call a top. This is a mature bull market. We're due for a bear market. That's the rhetoric. But the moving averages are not telling us at this point anyway, that there is any need to worry about volatility. It's any volatility at this point is probably just going to be normal corrective moves, and then the market will resume moving up. So at this point here, this is a pretty bullish look. You know, the same as this look from 97 to the top in 2000. There's no reason at this point to expect anything other than higher prices. And here we have the chart of the NASDAQ composite, and we have the same look. There's nothing bearish at all at this time about the configuration of these moving averages. They're trending higher nicely. No indication at this time that the market is, or that these averages are starting to flatten out, which would be sign for some concern and maybe time to start taking money off the table. That's not the case. And here we have the long-term chart of gold. Again, at bear market bottoms, you get this flattening process here, and then the moving averages start to turn and move higher. And at this top in 2013, the moving averages rolled over, a sign that caution was warranted. And now we have this flattening of the moving averages, and they're actually starting to trend slightly up, an indication that we have probably completed a final bear market bottom back in 2015, and we are now in a bull market, but one that is starting very slowly, very similar to what happened here in 2001 and 2002. Probably a new bull market, but one that is still basing. Here we have oil. Kind of the same thing. The moving averages are starting to flatten. They have not turned up yet, but this is potentially a bullish sign. And if anybody has listened to my videos before, they know that my expectation is that oil is probably going to be in a sideways basing pattern for a while. My expectation is oil is going to bounce around between 60 and 40 for a while, and that is kind of what these moving averages are suggesting. They're just now starting to flatten. So I wouldn't expect oil to take off and head towards $100 anytime soon. It's probably going to have several years of churning back and forth, building a base, trying to flatten these moving averages before they turn and move back up. So a market that's going to be difficult on either the long or the short side, and just probably a market stuck in a trading range. And here we have the moving averages on the dollar, the US dollar. And despite the bull analysis that the dollar is going higher, the moving averages are not confirming that. We've got this rolling over effect that is happening, and that is sign for caution, that this is what occurs prior to a bear market beginning. It doesn't always mean that a bear market is going to occur. We had something kind of similar here in '98 that did not turn into a bear market, but when you get the moving averages, the long-term weekly moving averages starting to give this kind of a look, it means it's time to be concerned with volatility rather than to ignore it during a phase like this. So the moving averages in the dollar are concerning. I probably would not want to play this from the long side. I would not want to take long-term long positions in the dollar right now. And I've got another indicator that I look at to determine bull and bear markets, and I'll go over that in a minute. And here is the chart of the euro, and we've kind of got the opposite view here in the euro. We've had a very long-term bear market. The moving averages are turning higher. The slower moving averages are on the verge of crossing back above the longer term moving averages. Doesn't necessarily mean that this is going to turn into a secular bull market, but this is a warning sign that maybe the market is finished with this long 9-year bear market and is ready to start another bull market phase. So probably not a great idea to be short this market. Now I'm going to show you something else that I look at that can often indicate, maybe a little bit earlier than the moving averages, whether or not a market is starting a bull or rolling over into a bear market. And that is where the yearly cycle lows occur. And I don't particularly care whether markets are making higher yearly cycle highs or not. Very often markets can enter sideways consolidations, or they can enter triangles. So the yearly cycle high isn't that important to me. I don't require the markets to make higher yearly cycle highs to remain in the bull market, but they do have to make higher yearly cycle lows. So you can see here in 2010, here's the yearly cycle low. In 2011, right here, you can see this low held above this one. 2012, here was a yearly cycle low, clearly above 2011. 2013, the market mostly just went straight up, but I guess you could call this was definitely an intermediate cycle low. So this would be classified as the yearly cycle low, and it held above the 2012. Again, in 2014, this yearly cycle low here, another higher low. In 2015, again, the yearly cycle low held above 2014, and then we get the anomaly. We get the 7-year cycle low, and that yearly cycle low did come occur below the 2015. So there was the potential that this could be the beginning of a bear market, but because this 7-year cycle was so extremely right translated, the odds were not very good that this was going to start a bear market. The odds were that this was just a 7-year cycle low. It was going to hold considerably above the 2009 low. And so this again was volatility to ignore. It was not going to be the start of a bear market. The multi-year cycle just was far too right translated for this to turn into a bear market. And so now we move on to 2017. You can see this intermediate cycle low here, which was the yearly cycle low, has occurred well above 2016. So the pattern of higher yearly cycle lows is intact, equates to this being a bull market. Now on to the gold market. You can see the bear market here. You can see that these yearly cycle lows were occurring at lower levels, a sign that a bear market had begun. But now the character of the market has changed, despite what so many people are calling that this continues to be a bear market. It is not exhibiting the characteristics of a bear market. We've got a yearly cycle low here in 2015. The 2016 yearly cycle low has held well above the 2015, and barring a complete collapse before the end of the year, then either July is going to turn out to be the yearly cycle low, or if we do continue a hard move down and make a slightly lower low below July, as long as that also holds above this 2016 yearly cycle low, then we are still in a bull market. Again, I don't care where the yearly cycle highs occur, because consolidations and triangles can affect the yearly cycle highs. All I care is that the yearly cycle lows keep stair-stepping higher, and so far they are doing that. 2016 held above 2015, and right now it doesn't look like there's much chance at all that 2017 is going to move below 2016. So by definition, we've got the long-term moving averages are flattening and turning up, and we've got the yearly cycle lows doing what they need to do. So the conclusion is bull market. Now let's go to the dollar. And again, here we have a lot of people predicting the dollar is going much higher, 120 or higher. The moving averages, as I've shown you, have started to roll over. That is not confirming that analysis, and we've got a problem. The 2015 yearly cycle low right here, you can see that the 2016 yearly cycle low occurred below that yearly cycle low. Now it's possible that that could just have been the 3-year cycle low like the stock market, and at first this rally would seem to have confirmed that because we made a higher yearly cycle high, but we have come back down and made another lower yearly cycle low below 2016. So we've got warning bells going off in the dollar. The price action, the moving averages are not confirming the analysis that the dollar is going higher, and the yearly cycles are not confirming that this is in a bull market. The opposite is the conclusion. Moving averages are rolling over. We need to be concerned. Volatility is to be concerned with. You need to pay attention to it. And our yearly cycle lows are making lower lows, which is usually a sign of a bear market, especially when you put it together with the long-term moving averages that are rolling over. So the conclusion here is that most analysts are wrong. The dollar is not in a bull market anymore at this top. More than likely this began a bear market, and we are going to continue to see yearly cycle lows coming in at lower levels. So the conclusion, the stock market remains in a bull market. There is nothing to suggest otherwise. Any corrective moves should be volatility to be ignored. You should expect any corrections will at some point end, and then the market will resume moving higher and make new highs. Gold, the conclusion is that gold is also probably in a bull market, and corrective moves should end before making lower lows, and then price should continue rising, but it is stuck in a sideways basing pattern, so it's going to be a difficult market to trade, and you're probably not going to get a lot of sustained upward trending moves like we're going to get in the stock market. So a bull market, but a difficult one that's still stuck in the early stages and stuck in a basing pattern. Dollar, a market that is giving off warning bells, moving averages rolling over, yearly cycle lows occurring at lower levels. Probably a market that is entering a bear, at least a cyclical bear phase, and possibly a secular bear phase. So a market where volatility is to be respected, and the anticipation of a new bear market is strong.